Hey traders, this is Blake Morrow with Trader Summit, and I have a special dual interview for you all today. I have Mr. Brent Johnson from Santiago Capital, and I have Deer from Deer Point Macro. Good to see you, gentlemen.
Thanks for having me.
Thanks for having
Yeah,
you
thanks,
all.
Blake.
Actually, you both. And Deer, how are you?
I'm doing well, doing well. So I'm in South Carolina this week, so that's it's always good.
That's back home, right?
Back home, yes,
All
sir.
right. Well, I love South Carolina. Went there for my first visit this summer. It was great for a kids national championship soccer games, and it was cool. So, hey, we got a lot to talk about, obviously, with today specifically. We have the 10-year continuing lower, yields are reaching towards 5%. So I think we can really just kind of start there because it seems like the bond market is central, talking point to the markets just in general. So let's start off with Brent. Let's start off with you. What are your thoughts about what the bond market's doing in the current environment? I mean, we're seeing stresses from all the tensions in the Middle East, the attacks in Gaza and Israel, and yet the bond market continues to slump. When I know there's a lot of supply out there, but at what point does it become more attractive? And what are your general views on the bond market here in the U.S.?
Well, in general, I have kind of stayed away from having a big opinion on anything on the curve 5 years and longer. And I haven't had a position on anything 5 years and longer, literally until maybe 10 days ago when we bought some puts on the 10-year when it rallied. It had gone way down, it bounced. And we just kind of feel like that with the budget demands of the US government, the rest of this year and in the next year, that probably barring some kind of an economic crisis where yields collapse either due to a flight to safety or a return to QE where the Fed literally pulls interest rates lower, barring those two events, we think that yields probably go higher. Part of the reason we think they go higher is because they can. What I mean by that is, I know there's a lot of talk about how these higher rates are going to lead to a crisis and a disaster, funding disaster for the United States. And while I agree in the long term, I think they can, quote unquote, get away with it in the short term for longer than people think that they can. And so I don't think the 10-year at 4.5% or 5.5% makes that much of a difference to the US government. I think it actually makes more of a difference for the rest of the world than it does for the US government. So we actually think yields probably go higher.
That's it's an interesting point of view that you think that the U.S. economy or the government rather could really sustain higher yields for longer. It's like you use debt, or the U.S. government uses debt. Obviously in bad times it can help kind of smooth out some of the rough patches that a U.S. economy might have, but it seems like we use it in the debt continues to go up even in the good times as well. So there's got to be, you would think there'd be some sort of point, inflection point where we do hit a wall. But it's interesting you feel that way. Deer, what do you feel, and how do you feel about the bond market today?
Yeah, I mean, I agree with Brent here. I do think that there's going to be certain aspects in which the Treasury market is going to continue to see just a massive amount of supply. Right now, I'm kind of anticipating probably by the end of the year, net coupon supply, which would be like net of quantitative easing or quantitative tightening, would probably be close to, around 400 billion. And then I think what you really get into is the supply and demand dynamics of bonds, in which, yields will probably continue to move higher because, really the last time that we saw this amount of supply come online was COVID. But obviously during COVID, I mean, you had a massive demand factor where you had, the Fed buying, you had commercial banks and foreign institution buying was very robust. But if you start to fast forward to today, I do think that, participants are either net sellers or much more reluctant to buy, unless you get like pickup via FX or kind of swap channels. And therefore, levered buyers and dealers may be forced to absorb more of that coupon supply, which I do think will start to put more pressure on system-wide leverage capacity. But I just am not sure right now where most of that demand is going to be coming from, because as we know, even some of the foreign institutions in the Treasury put out a piece on this, haven't or foreign nations haven't been as large buyers of treasuries as they were before, kind of in the beginning of the COVID period. And that was more of a function of just the fact that they run massive demand surpluses, and a lot of those have started to dwindle a little bit. And so there hasn't been as much need for these nations to be net buyers of treasuries currently. So those are kind of my thoughts on that.
So, Deer, from an institutional standpoint, which you're obviously very familiar with, at what point do institutional investors come in and say, "Look, I see it as being attractive. Like, why park my money in equities? Like, if let's say we saw a little bit of a shakeup in the equity markets, and say we saw maybe a 5 to 8% decline. Do you think that would be enough to maybe entice buyers to be stepping in to the bond market?
I mean, I do somewhat, but I do think that if you're starting to look at the marginal buyer of treasuries, they're going to become more price sensitive and leverage reliant than kind of what we've seen in the last few years. And so I do think that because of that, there's going to be a couple of things that happen. One, it's going to push up funding cost, I think, as well as that it's going to keep term premium extremely sticky. And then I do think that it'll start to cheapen swap spreads. So, I mean, if you were probably an institutional client, you would probably look at something like a short 2-year SOFR swap spread instead of maybe because one, you have less risk to any sort of additional tightening pressure that started to be priced in further out the curve. And so I think that that's what most of those guys would be doing, or they would be doing like butterfly trades. Like, just as an example, I'm not saying this one in particular, but like a 2s, 5s, 10s, where either they're selling the wings and buying the belly, or the opposite of that, buying the wings and selling the belly, because I think that has a much lower kind of lower carry profile if you look at like 5s, 30s than what you would get if you were looking at like 2s, 10s, for example.
Yeah, well, at what point does carry even matter? If you're risk averse, you're just like, screw it, I'll pay it, I don't care. Well, anyway, but those are great great comments, and I do appreciate them. Hey, I'm going to turn our attention to another market. I want to talk a little bit about gold, and I need to give you guys, first of all, a couple of plugs. As a trader and somebody who manages money. And there's obviously a lot of us out there. We love to listen to your views because you help keep us, help your macro views really help us as traders keep a good theme on the market. And Brent, you've been really great about that with your dollar milkshake theory, keeping all the dollar bulls in their seats and not freaking out. But I'm going to turn our attention to gold, and we will get to the dollar, so make sure you all stick around for that. But we're going to talk a little bit about gold because you just put out a video in it looks like your newer channel. You can tell us what the channel is called. It's the milkshake, and there's more to it than that. But you talked about the 3 reasons to be buying gold. Now, gold's had a recent 8% rally. We continued that rally today. I think we're up another percent today. Just straight up over the last week. What are your views on gold? And Deer, I want to hear your viewpoints here in a few minutes. But Brent, let's start with you. What are you thinking with gold, and what are your 3 reasons why traders should be long?
Well, it's a good question, and the truth be told, like right now, I don't think let me back up for a second. So I have 2 views on gold. I have my medium to long-term views and my short-term views. And I know sometimes it's hard for people to distinguish between a long-term strategic position and a short-term tactical position, but I have both. So in other words, as part of the overall asset allocation for myself and clients, we have gold as part of that portfolio. It's a strategic holding. I don't have any intention to sell that for many of the reasons that I think most people own gold. There's no counterparty risk. It's a proven store of value. Gold never goes no bid. It can't be destroyed in a deflationary collapse, and it can't be inflated away. And so in a world in which we live, I think gold should be kind of the foundation of every diversified portfolio. And I was really looking forward to adding to my gold position. And a couple of weeks ago on our, it's called Milkshakes, Markets, and Madness. If you go to at Milkshakes Pod on Twitter or online or on YouTube, you'll find it. We discussed that I was setting up for a really good buying opportunity on gold. Sentiment was really low. Positioning was starting to get into a place where it would make sense to buy. It had pulled back, or it had held up really well versus real yields. So in general, I think gold trades inverse to real yields. And the fact that gold had held up really well all year until the last Fed meeting, when they were more hawkish than was expected. And when the Fed came out and was more hawkish than expected, and they removed the expected rate cuts next year that they had previously shown on their dot plot, that made real yields rise. And when that happened, gold fell, and it fell about $100 over a couple of weeks. And again, because I already have a strategic gold position, I was really looking forward to adding to it, but I hadn't done it yet. And then we had the stuff with the Middle East, right? And the $100 that gold had given up over that 2 or 3 week periods post the Fed meeting, it was all regained back over the last, call it, week to 10 days. And I actually am not a fan of buying gold with a built-in war premium. I've never seen that pay off. Now, it doesn't mean that it won't. And if we end up going to World War III over this, then I would expect gold to be much, much higher. But because I already own gold and I don't have to chase it, I'm not chasing it here. And in fact, late last week, I think it was last Friday, we bought puts on the miners because the miners were up 10 to 15% over that same time period. And here's the reason why, is because I don't think that this is going to develop into a full-scale war yet, is maybe the best way to say it. And I think the market is still coming to terms with the fact that longer end rates are going to be higher for longer than most people anticipate. And so I think the market is still coming to grips with higher real yields. And I think when some of this war premium that I think has been built into it over the last week, and when the market starts to realize that maybe real yields are going to be higher for longer, I think that we're going to get another pullback in gold. Now, I was really annoyed when it bounced on this geopolitical thing, because to me, that's never a good sign for the long-term prospects of gold. I've never seen it pay off. It doesn't mean that it can't. I've just never seen it. So I am waiting for a pullback to add to my gold position. But now, having said all that, if you don't own gold, you should absolutely go buy some gold. And if your timeline is 5 to 10 years and you don't do short-term tactical trades, then you should go buy gold. So I'm not a gold bear. I just see a tactical opportunity to make some money.
That's great. So I'll sum it up. Maybe near term, intermediate, neutral to bearish, but long term bullish. And it's funny. Being in the markets, since the 90s, I've always heard gold as the inflation hedge. And that's going to come back at some point. People are going to say, "I told you so." Right at some point, yeah. But they'll probably end up rallying for the reasons that you pointed out, not so much for others.
Now, I think let me add one quick point, just because I don't want to forget to say this. Sure. The reason that I am bullish gold long term is 2 reasons. One is that I think we will eventually get into a situation, and it could be argued that we already are, where all fiat is getting debased, and perhaps getting debased at a rapid pace. And that's the environment where I think you could get dollars rising versus all foreign currencies, and gold rising versus all foreign currencies, but then gold rising versus the dollar. So I can remain a dollar bull versus all of the other currencies while also being a bull on gold. because of the debasement argument. And the other thing is that a strong dollar will literally break the monetary system. The monetary system will not work if the dollar just perpetually gets stronger. And I think when the monetary system itself comes under attack, gold will put itself forward as a possible replacement. Now, I don't think the governments are going to choose to go back to a gold standard, but that won't keep gold from raising its hand saying, look at me, look at me. You know,
Right.
so that's my long-term view versus my short-term view.
All right. Well, appreciate that. And you know, I do want to ask you about silver, but before I do that, I'd like to hear what Deer has to say about his views on gold. So where are you at, and how are you viewing gold in this current environment, Deer?
Yeah, I mean, personally, I probably don't have much more to add than what Brent has added. I mean, I've always owned gold for long term. I don't trade it tactically. But also, I mean, gold's always been because I think, as you know, my father's from Azerbaijan, which is a nation that borders Iran, which is also the only, I think, nation in the region that has been outspoken in support of Israel. So that's been a very interesting way to isolate yourself around neighbors who don't have similar positions, especially the Iranians. But you know, nevertheless, I mean, culturally as well, I mean, gold's always played a really big part. So I mean, yeah, I've always liked gold, but I do think that, you know, kind of in the short term, which I'm using this in the economic sense, which is very ambiguous. I do think that you know, I guess that kind of goes into the next conversation, but that the dollar is probably, from a tactical trading standpoint, something that I would favor more than gold, because I've just never really figured out how to trade gold tactically.
All right. Well, let's stay on that topic then, Deer. You know, the dollar. Let's talk about, and I think a lot of people still want to hear from Brent, but know his views. How do you feel about the dollar and about what Brent had to say as far as, you know, a debasement of fiat currencies where the dollar actually rises against all those currencies? And I know people, non-currency people, I'm a currency guy, but non-currency people really have a hard time understanding. Wait a second. You're saying all currencies are going down, yet the dollar is rallying against other currencies. They have a hard time understanding the teeter-totter theory between currencies. But how do you feel about the dollar and about what Brent had to say about the debasing effect?
Yeah, I mean, I definitely agree with that. Going kind of into the beginning of this year, I remember, I think almost the consensus was that the dollar was going to be in like the 90s at this point. And I mean, where are we now? Like almost think what, pushing up on 107. I mean, it's 106.59.
Yep.
But yeah, so I mean, I think that dollar strength has really surprised people. And I think that one thing that has led to that is, I mean, I definitely believe that the fiscal impulse within the United States has been absolutely huge. But I mean, then you start to get into the whole conversation, which we've talked about before, Blake, which is, you know, interest rate differentials, which I do think are also playing a very big part in kind of, you know, the strength that we've seen within the dollar. And then finally, obviously now with everything that's been happening, I mean, you see gold get bid, you see the dollar get bid. And I think a lot of that is also just because of what we're now having with geopolitical instability. But I mean, yeah, I think that the dollar long term has been, like, kind of since the beginning of the year, has been much stronger than everybody was anticipating. And I do think that if things get much worse, we could probably see it potentially hit where it was at when it hit that 114 mark last year. So as for the debasement, no, I definitely agree with that. I think that other currencies are probably going to start to fall much more rapidly than the dollar, which, I mean, in theory would then, I mean, in very simplistic terms, have the dollar rise relative to all the rest of these currencies. And I do think that that's probably going to be the long-term play. And I mean, I don't think in my lifetime, and I'm still relatively young, I'm in my late 20s, I don't know if we're really going to see a massive paradigm shift, but you know, that's kind of where I am on the theory of the dollar.
So staying in line with the dollar, and Brent, I'd like to hear from you, going back to like your dollar kind of theory here. You know, we in our time, Brent, you know, since for my time anyway, since the 90s, you know, we've never dealt with a major G10 economy unless there's something I'm missing here, where we have uh, basically something that the UK is dealing with, where they have high inflation but slowing growth, right? And when you get in a situation like that, is that just a recipe for a disaster, like with the sterling? What are your thoughts?
Yeah, it absolutely is. And I want to go back. If we were to rewind 13 months and we go back to September of 2022, the dollar index, which is, it's just a measure of the dollar versus, a handful of other currencies. So it's not representative of the whole world, and it's mainly versus the euro. But a little over a year ago, the DXY was like at 113, 114, and was at a 30-year high. At the same time, the Bank of England had to bail out the UK gilt market because it was going no bid in some cases. China was massively reducing the leverage ratio in their banking system to help counteract a contracting real estate market. The Bank of Japan had to intervene in both the yen market and the JGB market because it was starting to malfunction or cause volatility in their banking system. And the ECB, even though they raised rates for the first time in 10 years and took it off zero, they also set up a facility to buy Italian sovereign bonds. And so, this is, and the reason why this is, and this kind of goes back to my whole theory, is that we are in a situation where, even though things are really bad in the United States, and anybody who wants to paint me a dire picture for the United States, I will happily sign off on that dire picture. However, you need to hold the rest of the world to the same level of account. And when you do that, you realize that they are in the same situation, and in many cases, worse situation, and they don't have all the advantages that the United States has. And so if you look, so it was more pronounced a year ago, but it's still pronounced now. Is what we have is a situation where countries around the world are experiencing high levels of inflation in their local currency terms, slowing economic growth, and deflationary pressures in US dollar funding terms. And that is because the US is the global reserve currency. And because the US is the global reserve currency, and that means it's the most widely used currency, that means it's the most widely demanded currency. And so if you go out and you borrow money, you get a lower rate if you pay. In general, you get a lower rate if you borrow in dollars than if you borrow in, Turkish lira or dinar or whatever it is, right? And because a lot of business is done in dollars, international entities will just use dollars because then they don't have to try to match liability. They don't have to hedge liabilities and revenues and all this kind of stuff. So over the last, several decades, there's an incredible amount, 30 trillion or more of euro dollar debt, which is dollar-based debt issued by entities outside the United States. So entities outside the United States owe more than $30 trillion in US dollars. So that means when the dollar goes higher, those debts become harder to pay off. So think of it this way: even if interest rates were zero, if you had a euro dollar loan and interest rates were zero, but the US dollar appreciates 10% versus your currency, that's like a 10% increase in the amount of debt, right? And that doesn't even take into account the fact that US rates have gone higher. And so as US rates go higher and it pushes the dollar higher, it creates a potential funding squeeze in the euro dollar market, again, which is the dollar market outside the United States. And that's why you get funding pressure, deflationary pressure in dollar terms. And as those other currencies fall versus the dollar, they still need to buy important inputs to run their economies. Energy, food, you name it, is priced in dollars. So their input costs are going up as their local currency falls. So they're really and their revenues coming down because slowing global growth. So they've got a funding squeeze, they've got an input cost squeeze, and they've got, downward pressure on revenues. It's really the worst of all worlds for the rest of the world. So even though it's bad for the US, it's even worse for everybody else. And I think we're seeing a manifestation of that now across several markets.
Where do you think would be the breaking point? Where's like the inflection point that it really starts to to put on the downside pressure on other economies to where they may snap.
Yeah. Well, I think we were there a year ago. So we were there a year ago, and the central banks had to go in and save the economies. That's what central bank intervention is. When the central bank starts to intervene, you know the economy is in trouble. Now, it just so happened that at the same time that these other economies started to buckle, that the expectations for future rate hikes in the U.S. started to come down, and as such, the dollar pulled back, and that provided some relief of the pressure. But now, since July, that pressure is rising again. Now, not only is the dollar appreciating as short-term rates stay high, but funding pressure is rising as the long end starts to rise. Now, remember, a year ago, the curve was massively inverted. The short end was very high. I think it was at 4.5%. But the long end was still down at 2 or 2.5 or whatever it was, right?
Yeah.
Or 3. But it was massively inverted. Now, over the last 9 months, and especially over the last 3 or 4 months, you've started to see that long end come up a lot. And so now we're hitting a place where the lag effect of short-term rates being higher is going to start to hit. And you've got the long end moving higher, which is where a majority of funding takes place anyway. So you've got this massive tightening going on. Even if the Fed doesn't raise anymore and they just stay here, you've got this massive tightening effect as you move forward in time. And I think that has the potential to cause all kinds of problems. So while I think it's possible we have a recession in the United States, I am just as worried, if not more worried, about something breaking outside the United States as I am about something breaking inside the United States.
Well, that was going to be my next point, and just to your point regarding the tightening that is happening, even as the Fed keeps rates unchanged. This has been the chorus from all the Fed governors, really, and we're hearing from 5 of them today. I'm sure some of them are speaking right now, and we're going to be getting headlines anytime during this recording. But we've heard that as a chorus from so many Fed governors, and even tomorrow we'll have the Fed chair speaking at I think it's the New York Institute. I have to go back and look at my notes. Anyway, he's speaking in a forum where he will be talking about monetary policy. So it's going to be interesting to hear from him. But I want to stay with recession. We're gonna kind of cap it off with recession talk. But let's start with you, Deer. U.S. recession. Yes, no, we're gonna skirt it. No landing, hard landing. Where do you stand? And if the U.S. is not your focal point necessarily, if you're like Brent and you're like, I'm more worried about other economies, because I know you follow the spectrum of emerging markets as well, even other economies. Where are your thoughts as far as recession, U.S. and global?
Yeah, I think for the US, they're going to continue to kind of be the let's say the probably the best performing economy, probably within the G7. And the reason that I say that is there's always this battle between the fiscal authority and the monetary authority, right? So like if you're looking at where outliers are, which, maybe for people who aren't as familiar with that, just think of that as like essentially direct cash injections from the federal government to the private sector. It also includes things like, interest payments on government debt, but it's all like direct cash transactions. I'm of the economic opinion, within economic theory, that higher interest rate payments on debt is a fuel to aggregate demand. This is my opinion. So this has been, I think, a massive driver behind the fact that we haven't really had a massive slowdown in consumption. And so I do think that that's kind of allowed the economy to chug along. Now, as for the rest of the world, I do think that because of a function of the fact of how the economies are essentially set up, one, the United States runs a massive deficit, but two, when you start to look at places like Europe, Europe in general usually runs account surpluses. So one, I think that this tells us that they don't have enough domestic consumption to essentially consume everything that's produced domestically. So as a function of that, they have to export that. We have seen that United States imports have actually started to slow. So that's bad for exporting nations. But two, a lot of these nations are not nations that have, as Keynes talked about, and I've done work on this, like a high marginal propensity to consume. And so if you start to look at Europe, Germany has a very low marginal propensity to consume. The Netherlands do as well. The UK somewhat. Then you start to get into places like China, where now they're trying to stimulate, but almost all of that money is being driven into the public sector, because the private sector has never really been large consumers anyways. And so I do think that this kind of ability for nations like China, one, to kind of adopt a Western driven model where you start to focus on targeting consumption, has been a complete disaster. So I think China's going to continue to be, lackluster at best. And I do think that things are going to get very bad for the Europeans. And three, because I work in Toronto, I think Canada's probably pretty finished here. So I do think within kind of that aspect, the US will probably be, when you're comparing them, the US against them will probably, skirt on by, relatively unfazed. Growth will probably slow, but I don't think it's going to be like everybody else.
Interesting. And it's going back to Brent, your point of the least dirty shirt in the hamper kind of analogy in not so many words. But Brent, where do you feel, or where are you at as far as US? Are we heading into a recession? Are we going to have a hard landing? Where do you stand on that topic?
Well, I think it's more a question of timing than if. It's more of a when than an if. Of course, at some point we will have a recession. Unless the business cycle has completely been broken and we never have a recession again, then
wasn't that Yellen that said that? We'll never have
right. We'll never. And so the short answer is I don't know. And that anybody else that tells you they do, you should probably run the other direction, because nobody knows. So what I try to do is just figure out what the different probabilities are and how to prepare for these different probabilities. Now, having said that, I think we probably will have a recession. I think that it may take longer to get into that recession than many other people think. That said, it wouldn't surprise me if I wake up tomorrow morning and we're in a massive recession. But I also, again, because of some of these things that we've talked about, I think it's possible that the U.S. can kind of chug along longer than most people think they can, because of its relative standing in the world. But I do think we will hit a recession at some point, and probably some point next year. And I think most likely, again, I'll have to wait and see why it happens and what the catalyst is and stuff. My guess is that when that happens, central banks will react as they always have. And so I'm not expecting a 5 or 10 year Great Depression, like we had, 100 years ago. And as of now, I think it'll be short lived, because I think there will be a massive policy response if and when that happens. But again, I think you have to be prepared for volatility. And I think you have to be prepared for a slowing US economy. I just think you also have to be prepared that it's not going to only be a problem in the United States, and that you can escape this by going and buying emerging market bonds or emerging market equities or just buying commodities or whatever it is, because I don't think it's that simple. If you go back and if you look at any crisis over the last 25 years has coincided with US dollar strength. Now, whether the dollar going higher causes the crisis or whether the dollar rises in response to the crisis, I'm not smart enough to figure that out. I just know that the correlation is 100%. And I don't think it's different this time. And so the idea that we're going to have a massive recession in the United States, and China and Russia and India and the rest of the global South is just going to chug along and have a nice little picnic, it's really, really naive as to how the whole global economy works. And the analogy I'll use is, for anybody out there that has their own business and is listening to this, imagine either your biggest or your second biggest client just disappears and doesn't buy anything. My guess is that your business would struggle next year if that happened. Well, if the US goes into a massive recession, we are the rest of the world's either their first or biggest client. And if we go into a massive recession, then they're going to struggle because their revenues are going to drop tremendously. And, as what Deer was just saying a little bit ago, they don't have consumer economies where they can just start selling all those products internally. And if they do sell those products internally, there may be demand for those, but the demand is going to come at a pennies on the dollar price as to what they were previously selling that into the United States. And because those countries have massive debts that were taken on to produce the goods that they would sell to the United States, when they start selling those goods at pennies on the dollar, the debt that they took out to build those no longer could become sustainable. So you quickly get into a situation where the whole world is at risk. So the point I would want to make to everybody is we could have a situation somehow, I'm not quite sure how, but we could have a situation where this all gets worked out and the whole world rises together. We could have a situation where it doesn't get worked out and the whole world goes down together. We could have a situation where the US chugs along better than everybody else, or we could have a situation where the US does poorly and everybody else does well. But I think that last opportunity, those are the only four possibilities. But I think that last possibility where the US goes down and the rest of the world chugs along and does great, I think that's such a low probability event, it's almost zero. Nothing is ever zero, but that's as close as I can come to thinking of one.
That is a really great in closing thoughts. And Deer, just before we sign off here, how about you? Is any response that you might have to what Brent just had to say?
No, I agree with everything. I do think now really the question on the table, though, with all of this is what the hell ends up happening in the Middle East. Because I think, I mean, I know this has been on a lot of it's been all over Twitter lately. And I mean, I've tried to escape it because it's pretty depressing. But, I don't think I've ever seen Middle Eastern countries as united around this as they are today. And, I guess this is a lot of people wanted us to pull out of the Middle East. And now I think we're starting to see the repercussions of us having pulled out of the Middle East. And so I do think that that's probably going to be very interesting seeing how that all ends up playing out. And I'll end here. I think it was Bloomberg put out a piece on Bloomberg Economics that was essentially saying if you had like kind of a large scale war, and I think actually their estimates were very conservative because they were like, if it's just like essentially a proxy war, like kind of like what we're seeing now, oil will only go up like $5 or something like that. And we're way over that today. I think oil's at like 88 or 89, something around there. So, but I think that they said that would take out like almost 80 basis points of world GDP. And so, I do think that if this does continue to escalate, the impacts on world GDP could be very significant, just as a function of the fact that people have to realize the Suez Canal accounts for about 10% of global oil trade, but about 22% of global containers. And so the kind of logistic impacts of, a problem within that region, I do think would be very significant. And that is where we could start to see, inflation pressure start to increase again, and possibility of growth slowing. So I do think that that's probably something I will be continuing to monitor as well.
Well, gentlemen, I want to say this has been a wonderful conversation. I want to thank you both really for taking the time to spend it with the traders at the Trader Summit community. Brent, like I said, I love following your work. What's the best way for people to follow your work? Especially, can you give us that YouTube channel address again?
Yeah, sure. Yeah, so I'm pretty active on Twitter. Santiago AU Fund is the handle, but if you just search for Santiago Capital, there's a white seashell. That's me. I do a number of podcasts. We have our own channel called Milkshakes, Markets, and Madness. If you go to YouTube and search for that, it'll be there. It's also at Milkshakes Pod on Twitter. We put out a couple shows a week, and we try to keep it kind of fun and lighthearted. So if you're looking for something that isn't quite as dull and draining and just hardcore finance, we'd like to have a little fun with it. So hopefully you want to check us out.
I do appreciate that. And Deer, you're one of my newer follows on Twitter. I don't follow, it's like I'm very selective on who I follow, but I really appreciate your content that you put out. What's the best way for traders to follow your work?
Yeah, so mine's just on Twitter, which would be Deer Point Macro. That's all one word, deer like the animal. And I do write on Substack as well, which is all like free. I don't charge. It's just like a kind of a collection of thoughts. And the Substack's kind of all over the place as well, in the sense of what I feel about writing about on that day. But yeah, that's those would be the two best places.
Well, my outlet is just talking to myself. I think your outlet of using Substack is much more efficient. So I appreciate both of you so much for being here. And if you all listening in really appreciate what they had to say, make sure you give them a big thumbs up and jump down in the comments below if you have any comments, for Deer or Brent. So thank you, gentlemen. I hope you have a great remainder of the week, and Godspeed with Powell speaking tomorrow.
Good luck, everybody.
Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.